Thanks, Rob. That's a useful segue into a discussion now about risk management and how the RAFI methodology endeavors to ensure that investors receive a positive equity risk premium for taking on stock market risk. Can you talk about how the RAFI methodology seeks to ensure that investors are compensated for investing in the stock market?
Absolutely. If you look at the stock market valuation levels, the notion of a static risk premium where any investor should always expect 5% excess return for stocks is complete rubbish. You go back historically and you find that the risk premium for stocks over the last 80 years has been between 4 and 5%. That's the realized risk premium, and that's the risk premium that's been enjoyed by investors in a period of rising valuation multiples. Dividend yields 80 years ago were north of 5%. Now they're south of 2%. That rise in value per unit of dividend, or plunge in dividend yields, put it either way, adds to the incremental return of stocks over bonds. But it does it artificially unless you expect rising valuation multiples to persist forever. So you peel back the layers, the sources of return, and you find that the structural risk premium over the last 80 years was about half what most people think it is, 2.5%. And the rest was just a run-up in valuation multiples. Now, what does that mean? That means that in normal market conditions, you can reasonably expect a modest increment in return for a willingness to bear equity market risk, nowhere near the 5% that we're all taught to expect. 2.5% is a nice increment. But what happens when valuation multiples are high, as they are now all over the world? Then the risk premium probably is lower. Let's suppose it's 1%. Do you really want to bear equity market risk, all that uncertainty, to boost your return expectation by only 1%? Well, what if there's a mechanism that extracts 2 to 4% more out of the stock market by not concentrating your money in the most popular, trendy, beloved companies where you really shouldn't expect a risk premium? What if there's a way to invest in the broad economy in a fashion that boosts your return 2 to 4%? Well, now you're back up to a 3 to 5% risk premium.